Hello, good morning, good afternoon, good evening, wherever you are around the world. How are you today? My name is Rose Joshua. So today I'm going to do some teaching. I did promise in my last video I was going to talk a little bit more deep dive into different topics. And so today we're going to do a deep dive into what we call the Wealthy Baby Plan using universal life insurance. Okay, so I'm going to share my screen. All right. So it's a deep dive into universal life insurance, but especially focusing on what we call wealthy baby plan. I love babies, I love families. So let's talk about making our kids wealthy. Okay. All right. So recall from my previous videos that I've talked about term versus permanent. Universal life is a type of permanent insurance. And did you know that universal life has been in existence in Canada since 1979? So it's been around for years, and it's really like those who understand it can get really, really wealthy using universal life policies. So the premiums are unbundled, so you can see the investment portion and your premium portion and see how your investment is growing. And then there's a lot of options. So we're going to talk about options in a bit. So a wealthy baby plan is one that is purchased by parents or grandparents or a relative who has what is called an insurable interest. So typically for a child, just brand new baby from age 0, and that's legally from age 15 days and above, you can buy a wealthy baby plan universal life policy. Depending on your province, up to age 15, some provinces up to age 17, where you have to buy it for the child. In some provinces from age 16, the baby can buy the policy in their name, or you can buy it in their name, but otherwise the parents are the owners of the policy. So the main objective is to create a solid financial foundation for your child and give them an advantage when they're older. A wealthy baby plan separates the rich from the poor in the later generations. It's a separator. So smart parents would actually do a wealthy baby plan when their kids are younger, so they give their children an advantage. So factors affecting premiums are not one size fits all. So depending on the age, if you start when they're younger, it's cheapest. If you wait until they're older, it gets more expensive with age. Gender, boys pay more. And personal health, smoking status, family history, vocation, things like, if somebody does dangerous sports like scuba diving, hang gliding, those would affect the premium. And I want to make a note on parental coverage. So some companies would actually consider the policy amount that the parents have before they approve what you apply for your child. So for example, let's say you only had a 100,000 policy for yourself as mom or dad, and then you want to buy a 500,000 policy for your child. Some companies will say no. Okay, so because, well, it's for various reasons, it kind of keeps I would say keeps the children within the wealth range of their parents. So if you think that you're only worth 100,000, why would you buy $500,000 for your child? Something like that. But so depending on the company, they might approve or not approve a policy that is higher than what you already have in place when you're applying for your child. Okay. So advantages of wealthy baby plans. I've already mentioned some of it. The premiums are the cheapest when they are babies. The child, in most cases, kids are healthiest when they're young. By the time they start getting older, and type 1 diabetes, type 2 diabetes, things, all of these things that are befalling kids these days, things begin to make them literally uninsurable. So you want to cover them when they're the healthiest, which is when they're babies. It gives you the highest wealth accumulation because there's more time. So Time is the best friend of investments. Time is the worst enemy of investments. If you start late, it's your worst enemy. If you start early, it's your best friend. So when they're younger, is the best time to do it. And then what happens then is you create a habit, you create a family tree, and what we call a systematic tradition that helps your children to know what to do when they have kids of their own. So for example, if you set up a wealthy baby plan for a baby born in 2020, when they have a kid, they'll set it up for their children. When those kids have a kid, they'll set it up for their grandchildren. So basically, you create a family tree where wealth flows from generation to generation. And of course, you do know that when you're buying that policy for your child, is because the child is going to live long. The average, the life expectancy for Canada is about 85, 95. So you're basically setting up wealth for 3 generations down the road. So when you buy it now is not necessarily for now, okay? So 3 key advantages of the universal life policy type: flexible premiums. You can start, stop, suspend, resume. You can do a little amount. When cash flow is low, you can do more money. When you get your tax returns, you can do lump sum. You can pretty much, the premiums are amazingly flexible, okay? And one of the biggest things that parents worry about is that, oh, I'm going to set up this policy. I'm going to pay for this child. Or is it only me paying? But here's the thing. You start, and then when your child can take over, the child can take over. So basically, you don't have to pay for all of it, okay? So that's the one advantage. The other advantage is that because it's invested, it accumulates money tax-free. So it is tax-free. You do know, of course, that the death benefit is tax-free, but then depending on the way you structure your universal life payout, you can get all of the investments tax-free as well. So that's a very big key that you want to pay attention to in this presentation. So there's payout options, what I call level or loaded options. I'm going to give some examples. So in a universal life policy, you grow cash, okay? So part of the money is invested, like we just said. You get to select the investment funds. So if you find in 1 year the investment funds you selected are not doing well, you get your annual statement or quarterly statement, you don't like the funds, you can change that. So you get to select your investment funds, okay? And then the most common interest around universal life policy is, what can I do with the cash value? So everybody's saying, what am I going to do with the cash value? What is in it for me? And so the cash value is a big deal. So we're going to talk about it in this presentation as well. Okay. All right. So the death benefit options. I would say right now, without having a statistical quote, is that most people automatically take the level face amount because it's the lowest cost universal life option, okay, payout option. But then there's other options like your face amount plus cumulative premiums. So when you have face amount plus cumulative premiums, then it gives you your guaranteed face amount. So let's say you buy a policy for $500,000. Your $500,000 is a face amount, and if you take the level, that's all you get over time. Face amount plus cumulative premiums at death would pay out whatever premiums you had paid back to your beneficiaries. So it's like insurance for free. Then the real big deal is face amount plus account value. And this is the one I have for myself, because this is the one that really allows you to eat your cake and have it. So you have the face amount guaranteed plus the investment fund as well. Okay. And of course, some companies offer the index death benefit, which is inflation adjusted. So I'm actually gonna switch over to an example here. So this is an example that I created. Again, Disclaimer is for discussion only, is not an actual illustration. So if you want something for yourself, give me a call. Let's sit down and do something for you. But this is for illustration of how the death benefit options work. So in this example, this person is paying $100 a month, so $1,200 a year. So the death benefit here is $500,000. So you notice the cumulative, the death face amount plus accumulated premiums adds the $1,200 a year. So at the end of year one is $501,200. And then the invested fund is added to the face amount with the investment fund value. So over the years, this is for a child aged 0, brand new baby. And so if you go to the end of 30 years, because in this example, they're paying for 30 years. At the end of 30 years, they would have paid 1,200 times 30, that's 36,000. And so the face amount plus cumulative premiums pretty much stalls at that point. It's 536, and it's 536 to the very end, okay? And the face amount only is $500,000, face amount guaranteed $500,000. So if you look at those two columns, it really stalls even all the way to age 100. All the way to age 100, it stops at, face amount is 500,000 and 536, because that's the amount of money that was paid into the account. Now, the face amount plus fund takes your investment value, adds it to the death benefit. So this means that, God forbid, let's say this is a, I don't know what age, 50-year-old person, you buy the policy and let's say the person passes away in 1 year. Whatever you paid or whatever is in the investment account is what will be paid to your beneficiaries. So starting from day one, that applies. Now, in the early years, depending on the premium you pay, the cumulative premiums might be a little bit higher than the fund value. That's because, remember that part of your premium is used to invest. So not the entire premium is invested. However, at a certain point, typically after the first 10 years, then the invested value actually begins to compound faster. So it switches places. So now, if you take a look at the investment value, just comparing that by year 40, invested amount is plus face amount is 616, and those two are same like we talked about. If you look at, say, age 65, face amount is 500, cumulative premiums is still 536, and the face amount plus invested amount is $1 million. So there's a big difference there, and you're paying more for the policy, but you're not paying $500,000. You're paying, sometimes it's $50 more, $100 more. So it's not breaking the bank. So like I said, this is what I have for me. I have 5 children, so I really want to maximize my face amount. So I have the face amount plus investment fund. Okay. Now, depending on the company, I want to make a note here. Your face amount in this example is guaranteed $500,000. Now they're growing an investment fund out of which, let's say the person passes away before prematurely, they would have to top up the investment fund to pay out the beneficiaries. But let's say now you get to a point where your investment fund is higher than $500,000. The company may decide to add the extra to your face amount. So depending on your company, it's really good to know what the policy is regarding the extra investment amount, especially in the later years, because otherwise you're stuck with just the flat level face amount. Now, so if you do have an insurance policy, UL in place, Universal Life in place right now, talk to your insurance company and find out for sure. If you don't, definitely come to me and I'll help you set it up correctly, because I've studied this. I really have looked at the math. I've spent a bit of time number crunching, and I know basically how to set it up. So come to me and I'll set it up correctly for you. So that's it. So your way to go where you really eat your cake and have it is the face amount with investment fund. And again, like I said, most people are sitting at the level face amount. All right, let's leave that. Okay, so some examples, fictional names, of course. This is a story of 3 children, A, B, and C, with 100K wealthy baby plan. A's parents got it when he was 1 month old. B's parents are 6 years old. C's parents are 10 years old. So they're all paying the same amount. This is an example with same premium for 30 years. If they all pass away at age 85, the beneficiaries will get an estimated 4 million for the one who started at 1 month old, 3 million for the one who started at 6 years, 1.5 for the one who started at 10 years. So again, it does hurt to delay. So if you have kids, now is the time to set it up for them, because every year you delay, you're gonna pay more, likely, and also you're gonna get more. They're gonna get more less. Pay more, get less in the end. Pay more, get less. Here's another example, impact of the benefit option. So here's an example with the level face, face with cumulative premiums, and face with investment accounts. So we have 3 sisters with their boys, got their policies at 12 years old. So premium for the first one is 80 per month for 40 years. Next one is 100 per month for 40 years. The other is 120 per month for 40 years, okay? Again, that's demonstrating the difference depending on the insurance company, the difference between your level face and the face amount plus. So down the road, let's say they pass away at age 85, beneficiaries would receive estimated 300K for the level, 348K with premiums, $1.9 million with the fund value. So there's a big difference there. All right, so how do you access your cash value? This is one of the biggest concerns that parents come to me with. How do I get the money? How do I get the money? How do I eat my cake and have it? So you can withdraw from the cash value for many reasons: education, home purchase, weddings, and so on. But we do need to sound a note of warning. Every money that you withdraw will impact the death benefit. Or even if you take a loan, it will impact the death benefit. So you can access your cash value through premium holidays, withdrawal, policy loans, collateral for third-party loans, and surrender. So cash value for premium holiday means you have an accumulated cash value. And so every year the company would deduct what they call the mortality deductions, meaning the payments to cover you for insurance. So if you stop paying, they would automatically withdraw from the cash value. That's what that means. So as long as you have sufficient money in your cash value, you can take what is called a premium holiday, and they will tell you exactly how much time you can take. So here's an example. John's parents, David and Mary, got him a wealthy baby plan of 500K when he was born, when he was 15 days old. They paid $50 a month. I mean, they had a minimum $50 and a maximum $1,000. They chose to pay $100 a month. So 5 years later, somebody gets into an accident and cannot pay. They're able to go on a premium holiday for up to 7 years. So in some cases, in fact, I have a client right now who is on premium holiday for about 15 years. So he may decide to start paying down the road, or he may decide to stay on a holiday, okay? So it just means that there's enough money in the cash value to actually take a break, all right? So getting a loan, this is a big one. And I'm gonna do another video on what is called the insured retirement plan, because it's really around getting a loan. So there's different ways you can get a loan from using your cash value. One is from the insurance company itself. The other one is from a third-party lender. So from the insurance company itself is called simply a policy loan. From a third-party lender is a collateral loan, is an insured retirement plan, is all kinds of names. Okay, so let's take a look at the policy loan. It's a direct loan from the insurer. There is an interest rate attached to the money. But however, your cash value continues to grow tax sheltered, and the loan does not have to be repaid. But when the person passes away down the road, the death benefit is minus the loan balance and minus all interest accrued. Okay, third party collateral loan is not from the insurer. It is from a third party lender. There is interest. The lender is registered on the policy, very similar to a mortgage. So the lender has interest in your insurance policy. So very similar to a bank registering themselves as interested in your house, okay? So cash value continues to grow tax-free. Loan does not have to be repaid. The death benefit lender is paid first before beneficiaries, okay? So here's an example. Cheng's parents got him a wealthy baby plan of $1 million. When he was 2 months old, they paid $300 for 30 years. When he turned 50 years old, he applied to his bank for a collateral loan registered against his UL plus his house. So same concept for IRP, and I will talk about that in another video coming up in the next week or so. So the bank approved him for $500,000, which he used to start a business. So again, you can borrow, we use your life insurance just like your house as a collateral. Another way to access your cash value is by directly withdrawing from the bucket. So direct withdrawal from the cash bucket. So it's called a surrender, partial or total. And there's limits because they don't want you to withdraw everything, because if you do, it could shut down the policy. May trigger taxation. Actually, policy loans from the insurer may also trigger taxation, but again, you need to find out exactly from your insurer. And death benefit, of course, is minus all withdrawals. If totally surrendered, I mean, if you take everything and the cash value is zero and you don't make additional payments, then the policy will shut down, okay? All right, so here's an example. Cindy's parents got her a wealthy baby plan of $500K when she was 2 years old. Bright student, she had an RESP. She used that for her bachelor's degree, but she wanted to do medicine, so she needed more money, and she was able to get $50,000 directly from the cash value of her universal life policy. So again, sometimes parents submit paying to RESPs, but it may not be enough. So this is another way you can get extra money. Remember that for children, the only investments they have is the RESP and the universal life. Kids don't have investments. They're too young. So between the ages of 0 and 18, the best thing you can do for your child is, in addition to the RESP, also have the universal life policy. This is something I advise parents all the time. Otherwise, you expose them, you're going to be spending your own money, and so on. Cash withdrawal example, Zena's parents got her a wealthy baby plan when she was 1 year old. Face amount plus account value, $100 per month. When she graduated, her parents helped her to withdraw $30,000 from her cash value towards down payment on her small house, okay? So here's the thing. If she only had an RESP, she cannot use her RESP for down payment for a house, okay? But you can use money from your universal life for down payment for a house, or to buy a car, or whatever it is that you need, not money from an RESP. So again, please parents pay attention to that. So impact of direct withdrawal, you're taking money directly from the bucket, so it will actually slow down the compounding. It needs to start recompounding. And so you may be required to add more money to the policy. But again, review all the options. If you need money, review all the options and then decide on what you need. So in conclusion, we have done an overview. Again, this is me just touching the tip of the iceberg. I need you, if you don't have a universal life policy for your child, even for yourself, contact me. I'll help you set it up correctly. You know, a solution that's best for you and your children. And so let's meet and let's take care of that. Okay. So we have reviewed UL impacts of age, gender, and so on. How you can work with the premiums, how you can customize the benefit payout, and how you can customize using your cash value. So again, talk to me and let's help you to get everything properly set up. All right. Thank you so much. Again, reach me at 780-680-1334 and let's help you and your children. God bless you. Have yourselves a very, very good rest of the day. Bye now.